So let's talk about uses of Fibonacci levels and how to best utilize this system. So Fib levels can be used to identify areas of interest, such as, and for the purposes of support and resistance levels. We can pinpoint levels of retracement. So let's say price came up or shot up, and we're trying to see, all right, price is up at, let's say Bitcoin went up to 50,000. We want to see, all right, well, where could price fall down to, and what would be a good entry level? This could be a good level as well in terms of retracement. Price goes up, we want to see where is it going to retrace to, what would be a good level of support. Same thing as resistance. So let's say price is in a downtrend. Price does come up. All right, where could it stop at? What would be the retracement level that it could be stopped at? What would be a significant resistance level? That could be a level to potentially short depending on market conditions. Once again, and this really just goes hand in hand with trade entries and also with trade exits. If you're in a position and you're seeing, all right, I caught this support level, I want to see, all right, where could price go from here? Well, these retracement tools and retracement levels can give potential areas to take profits or to overall just leave the trade or exit the trade altogether. And with that, we also have stop loss levels, because with support and resistance levels and trade and entries and retracement levels, we also see levels of invalidation where if price is coming down and we're thinking that this is some sort of support level, not only do we have to have the idea of, all right, this is my entry, price can go up to here, we also have to consider, where is my point of invalidation? If price is here, what would invalidate that? What price level where could price go to invalidate this price theory where I know I'm wrong? We have to consider that as well. And Fibonacci tools can help map out that whole situation, the whole mindset of saying, all right, this is my support level. I'm going to place my stop loss maybe 5% below the support level that way, but 5% below my entry. That way, if price does drop down below even a little bit, maybe it comes down to 3%, I'm still not necessarily wrong, because I think that price can continue to move back upwards. But if price does fall, maybe it falls down to the next fib level, my stop loss is there to prevent further losses. Here's an example of price coming down. So this is the Ethereum on the 4-hour chart. Price came down from 36.75 down to 26.51. And we generally see price really held true to these Fibonacci levels. We came down here, and let's say price came up and it came back down. All right, where could be a potential entry? Maybe I saw all this happening and I said, all right, well, price is coming back down to here. Maybe this would have been some sort of potential entry. This level, this 0.236 level. If I did enter off of this and I had a large enough stop loss, because it does seem that price did come back down a significant amount from 2,900 to about 2,750, give or take. So that's a significant amount. That would have been a little bit higher than 5%, right? So let's say price came down, but maybe I caught it around here, right? And I caught some sort of breakout, or price came down to here again, and I saw the retest. It produced some sort of higher low compared to the low over here, and I considered, all right, well, this might be a potential good entry. If so, maybe I would consider this would be a potential profit target, and if price keeps going, I can consider this a potential profit target. In this particular situation, both of these held true. Both of these were accurate levels to trade off of. And once again, this is something that I specifically dropped in and I'm using as an example. Will this always work? No, nothing always works. This is just an example, but this is just one way that you could potentially use it in conjunction with other technical analysis tools. Once again, let's say price was up here. all right, well, I'm thinking price might come down to here and maybe bounce off. We did see that this particular level did hold as a significant level of resistance in some way, shape, or form. Yes, price did drop down below it, but not necessarily significantly. Let's say if we entered here, once again, we're going to take profits here, and we're going to keep a portion of the trade still in play, and we'll take profits at each one of these fib levels. And if we did that, we would have very accurately and safely secured profit along the way, along this ride, right? Letting this ride from 2,800 to 3,600 in a given trade, that could have been considered a risky trade, right? We always wanted to make sure that we are taking profits along the way and securing profits. We don't want to risk too much by leaving too much on the table, so to speak. So by using this, now we can start to plan out different levels of take profits. More on fib level uses. So traders use fib levels to identify potential entries, price targets, exits, stop loss placement. It can vary based on a trader's strategy, setup, and style. One thing to note is that fib levels and the retracement tool is usable across all time frames, across all trading styles, whether you're a scalper scalping off the 5-minute or you're someone swing trading off the daily chart. Fib levels can be used in both situations. Now, a trader could consider profiting off of market fluctuation between two specific fib levels, similar to range trading with standard support and resistance lines. In the previous example, we saw Ethereum bouncing between the 0.23 and the 0.38 level, and that was one way that we could have potentially used the fib levels as a replacement for support and resistance. In this case, a possible entry could be buying at the 0.382 retracement level, then selling at the 236 level. Once again, it's important to consider other technical factors for entries as well, and not solely rely on Fibonacci levels alone. We want to have a diverse case for our trades. We don't want to just rely on just one tool, just one method of analysis. We want to build a case as to why we think the trade is going to go in our direction, and to overall increase our confidence and the probability of the trade actually happening. Let's touch a bit on how to properly use the fib retracement tool. So to use the fib retracement tool, we want to first identify two significant price points, such as a high and a low in a trend. These serve as your anchors where you're going to drop the tool off, as shown in the previous video. These are the anchors for the tool. You want to consider swing highs, which we would say is a high with lower highs on both sides. It's a noticeable high or maybe a peak. And swing lows, which would be a low with a higher low on both sides. So this would be a noticeable low, or maybe the bottom of a trend. Now, wicks can be used for anchor points, both high and low. Candle bodies can be used as well. The main thing is consistency. I generally focus just on the wicks when it comes to the Fibonacci retracement, but I have seen it used with candle bodies successfully as well. It really comes down to preference. But main thing, once again, is consistency. Make sure you're only using wick to wick or body to body. Now, the range of the tool is drawn according to the underlying trend. So in an uptrend, the low point would be 1, while the high point would be 0. In a downtrend, this would be reversed, where the low point would be 0 and the high point would be 1. Regardless of the trend, though, you always want to draw the fib levels from left to right, not right to left. So if you, let's say there's some high point over here and the low point over here, you're going to draw from that high point to the right to the low point. Vice versa, let's say there's a low point here and price came up to some high point. you're going to draw from left to right. You would never go backwards. It's generally not advised to go backwards or fib backwards in a Fibonacci retracement placement. You always want to draw from left to right. Go into the future. That way you can see what's going to happen as opposed to looking to the past. Here's just a refresher on swing highs and swing lows. If you haven't, I highly suggest you watch our advanced market structure video. That way you can have a proper understanding of market structure and changes and shifts in the market structure. We go a lot more in depth on swing highs and swing lows, and if you're not familiar with it, I highly suggest you're doing yourself a disservice if you haven't checked that out. So here is our swing high example. Here is our high with a lower high on both sides. So here's our noticeable high and the lower high here and a lower high here. So this is noticeable. It sticks out. Same thing with our swing low. It's a low with a higher low on both sides. Here is our extreme low, the very bottom. And here's a low to the left of it. It's a little bit higher. And here's a low to the right of it. It's a little bit higher, right? Now, in the bigger picture, this is what this would look like. So maybe this would be a swing high, a noticeable high with a lower high to the right and lower high to the left. A swing high here and lower high to the right, lower high to the left. Another one here as well, and another one here as well. We see several swing lows as well. Here's one as well. A swing low here, a swing low here. One could try to make the argument that there is some sort of swing low here, but generally, if it's not obvious and if you have to try to force it, it's probably not accurate, right? So we don't want to necessarily force things or force analysis or force trades, right? There's so many trades out there. There's really no need to try to force. There's always going to be more opportunities. So if something is not necessarily clear and makes sense, don't force it. Placing fib retracements. So once you identify that swing high or the swing low, the question becomes, which one do you pick an anchor for? Situational. It depends on what you're using the tool for. Typically, though, you want to place the tool on obvious swings. Which highs or which lows stick out amongst the rest? Now, within that, look out for swing highs or lows at the bottom or the top of a big move. These generally make for good anchors. That way you have a bigger perspective on the market, a more macro viewpoint. And this is something that's valid across all time frames. On the daily, the 15-minute. As we saw on the daily, we were able to identify that extreme high of 69K for Bitcoin. We placed the retracement tool there. And in more recent times, in late January 2022, we came down to about 33K. So that was our swing high and our swing low. Within that, now we're starting to have a clearer vision or a clearer picture of where price could retrace to as it goes back to the upside.